How exactly does a corporate accountant place a concrete legal price tag on a human being? Or, for that matter, a thought? For most of modern history, business valuation was straightforward. A company's worth was tied directly to the physical objects it owned, which meant accounting was largely an exercise in counting tangible assets. Think of a classic mid-century department store. You tracked inventory using methods like first in, first out, literally counting the boxes arriving at the loading dock and the physical goods sitting on the shelves. Today's economy is built on assets you can't touch. Software, brand loyalty, and proprietary algorithms drive modern markets. Because physical inventory no longer defines a firm's value, accountants have had to shift their focus from the warehouse to the balance sheet, developing specific frameworks to quantify the intangible. The first major category of this invisible wealth is intangible assets. This includes legal protections like patents, proprietary technology, and corporate trademarks. To assign a hard dollar amount to something as abstract as a brand identity, accountants rely on a specific accounting tool called the relief from royalty method. Instead of measuring how consumers love a brand, you calculate the rent a company pays to license its own brand. By keeping it in-house, the company saves that fee monthly. Compounding these savings over years forms the trademark's exact valuation. A brand's financial value isn't based on its popularity with consumers. It is measured strictly by the financial pain a company avoids by possessing it. Which brings us to the most complex corporate asset of all. How does an accountant price a human brain? The answer lies in a specialized system designed specifically to quantify human capital, known as human resource accounting. Traditional ledgers treat payroll and employee training as standard operational expenses, money out the door. Human resource accounting treats human beings strictly as investments. This framework tracks the changing value of an employee over time. It captures the compounding financial impact of every training seminar completed, every new skill acquired, and the on-the-job experience that makes a worker more efficient. By treating humans as measurable investments, employee development stops looking like a sunk cost and becomes a highly trackable, appreciating corporate asset. There is one final hurdle in invisible valuation: placing a price tag on a project or outcome that hasn't even happened yet. To tame uncertain future choices, financial managers use a structural framework called the Multiple Attribute Decision Model, or MADM. This animated decision tree breaks down the MADM process. It begins with an initial choice, represented as a single point called a decision node. Those diverging pathways lead to chance nodes. These circles represent multiple possible outcomes, each assigned a strict statistical probability, like an 80% chance of high user adoption versus a 20% chance of failure. Next, we assign hard financial costs to each branch. For instance, spending $50,000 to build a brand new app compared to $25,000 to upgrade an existing one. By multiplying the probability of each outcome by its financial return and then subtracting the initial cost, you calculate the expected monetary value at the end of the tree. Decision trees convert the chaos of future possibilities into present-day mathematical equations, mathematically guaranteeing the most logical choice before a single dollar is spent. These abstract valuation tools laid the groundwork for the new economy, an environment where physical machinery was rapidly replaced by computational data processing and algorithms. Modern juggernauts recognized this shift and weaponized it. Companies like Netflix and Spotify abandoned individual physical media sales entirely, pivoting to invisible, digital monthly subscription models. This birthed the exponential business model. The core value of these platforms is driven by network externalities, a principle where a service becomes exponentially more valuable with every new person who uses it. Take the traffic app Waze. By marrying basic GPS data with real-time input from its users, Waze built a constantly updating map of global traffic. With only 100 employees and without owning a single physical road or speed sensor, they sold to Google for $1.3 billion. These frameworks offer a window into how the world's most valuable entities actually operate. In a landscape where the most significant assets are invisible, the ability to calculate their worth is what separates a guessing game from a billion-dollar strategy.